Well, I'm delighted to do this. I'm actually also a search fund investor. I've invested in a bunch of them over the years. So it's going to be really hard for me not to weigh in on these questions. This is one of those ones where I want to ask the question and answer it myself. But I will really try to be a moderator and not a panelist on this. In my way of thinking, there are sort of three categories that we should address. And what I'd like to do is kind of get panelists' views on these three categories and then open it up to you so you can kind of ask questions. So it's not me just driving the process. But let's get them to sort of give positions on what I think are the three critical things, and that is deals, number one. You know, where are the deals? How are they being priced? What sellers are out there? Where do you find them? What's the availability? Are deals closing, et cetera? So the whole deal package is one that you need to find. Then secondly, you got to have money to close deals. So who is investing in searches today, and who is investing in closing deals, and what kind of debt is available? We all know the market conditions now, so we won't spend a whole lot of time lamenting what's going on in the capital markets, but just get the panelists to really talk about what's happening with search fund deals. And then the third category that I think would be interesting to you all is the whole issue of process. You know, do you do it solo? Do you do it with do you focus your search on a particular industry, a particular geography? Do you think opportunistically? Are there certain categories? Are there ways to make your search more effective? How do you present to investors? You know, anything that we can learn from that standpoint. So let's start with the deal thing, and I'll just let you volunteer. What do you see on deal availability and pricing today? Have you seen moves? Do I need a cold call? 'Cause I'm not above it.
I think fewer transactions are getting done now just because people are sort of in a state of shock, and you're seeing that pretty much in every line of work. And so you're seeing fewer deals. But they are getting done. People are finding them. It's just not as easy.
They're closing.
Well, we're hoping to close a few in the next few weeks, but you are getting LOIs, and you are getting interest from the financiers and such that it's not completely frozen. So I think that's at least we at Search Fund Partners look at that as we're optimistic that even if here at hopefully the depths you're seeing transactions, that, 6 months to a year, you'll see a lot more activity.
How many of you have closed a deal in the last 90 days? Yeah. Okay, so we have actually a real case here.
Yeah, it was a manufacturing company, and it was able to get a senior note. It was asset-based financing, and it was done at a reasonable multiple. And I think like a lot of the deals in the market today where they're good deals, there was an underlying catalyst. There was a health concern with the principal seller, and so they were forced into the market. And I think the deals that I've seen at more reasonable valuations, for good companies, that tends to be the case. There's some catalyst that's pushing people out into the market today rather than allowing them to choose to wait and time the exit a little bit more appropriately.
Now, I always think a reasonable multiple is a semi-quantitative term. Can you be more specific? But what is a reasonable multiple in today's market? If you're willing to share that.
Yeah.
Or just speak generically. What kinds of multiples of EBITDA are you seeing today?
4 to 6, I think, for a company that shows reasonable growth prospects. A high growth, 20% a year for the past 5 years is going to trade at a higher multiple. And something that's stagnant is probably going to trade at a slightly lower multiple. Although I've talked to a number of brokers lately that say that there's a lot of sellers out there that have companies that have been flatlined where they want a 10 or 11 times multiple. So there's a disconnect sometimes between the seller's expectations and the reality of the market.
Have you found sellers moving down in pricing? That's one of the areas that we've found. They've been pretty sticky.
They have. I think we're just starting to see a little bit of the corner being turned in that respect. I don't know what the other panelists here are seeing.
I would say we are less optimistic about the current deal market. I think good companies right now, unless a seller has some exigency that's forcing them to sell, this is just a lousy time to be trying to sell your business. You're not going to get cash for it. You're going to get a relatively low price. So the good companies, unless there is a distressed seller, the good company isn't going to be selling, and the distressed companies, it's very hard for me to see how those companies are going to get bought in this market unless it's on a pass and a prayer, because historically the way the valuation metric is trailing 12-month EBITDA, next 12-month, future 12-month EBITDA, and then you apply a multiple to it in rough terms. The reality is no one knows what equilibrium EBITDA is for any business that is suffering the consequences of this economy. So applying a multiple is figuring out what the multiple is one piece of it, but the reality is you don't know what number to apply the multiple to. So I think it's going to be very difficult in our assessment to get deals closed in the next 12 months.
You know, one of the things that's occurred to me is there are a lot of deals that are in private equity funds now that have a finite life, and so people need to come out of deals. Have you seen any of those where you, as a searcher, could go into a prior private equity investment and buy out of one of these funds where it's not actually a distressed sale, but it's somebody who has to prove up a value, close out a fund, do something like that? Has anybody seen that, or is that just a theoretical idea? The latter.
Theoretical, I think,
Yeah.
at this point, I think.
We saw it once, but we were used as a stalking horse to sell the equity back to management.
Well, I know Jim has some information from a survey you've done. Would you be willing to share that with everybody?
Sure. I was given this question to think about in advance of this, and I really didn't know the answer. I have an opinion, but I decided to send out a survey to the 18 actively searching search funds that I have an investment in. And so I asked them a series of questions that I think might be instructive here. And so we put it up on the screen. The average search fund in this universe is 14 months of age. So keep that in mind. And I tried to distill this thing down into the very essence of what would be predictive of a successful search process. And I started with 4 questions. How many phone calls have you made where you connected live and talked to an owner of a company, and that was the first conversation you'd had with that owner? The second question I ask is how many face-to-face meetings have resulted from your personal phone calls? The third question was how many LOIs did you send out that were executable, whether or not you got them signed being beside the point. And then finally, how many LOIs did you actually get signed and attempt to close a deal on? And this universe made 3,895 calls over the last 14 months. Now, some are 25 months in age and some are 4, so it's an average of that group. And I asked them to give me the numbers in before and after November 1, 2008. And this was our way of getting at a point in time where a big enough change had occurred. Nothing took place in October and in September and October. Business just ground to a halt. But signs of life started back in November. And so we decided to just ask the question in this before and after way to see if there were differences between the answers. Now, it's only relevant here, thank you. In the next slide, it takes those numbers up above, and it gives you the average per month per search fund. So this says that before November 1st, the average search fund was making 15.7 successful calls with sellers. After November 1st, they were making 19 calls per month per fund. That was resulting in 1.8 meetings per month before, 1.2 after. I think you can read. I don't have to read it to you. So, no, go back up. 33%, 25%, and 40% down. So there's definitely been a fall-off in the number of meetings and attempted LOIs and actual LOIs. The average terms for the deals that were under LOI, were signed by both parties, are kind of interesting. Before November 1st, the average company, I'm sorry I didn't put the units, but that's $6.8 million with $1.1 million of EBITDA, a 16% margin. That is the average company in this universe that was under LOI, and it's as you can see from the EBITDA, it's really, in my opinion, below viability. Afterwards, though, the companies averaged $13 million of revenue and $3 million of EBITDA. It's a 23% EBITDA margin, and so the jump is kind of staggering. We ask about deal terms, and the purchase price multiple before and by these last three categories, lines 12, 11, and 12, 13, and 14, are probably not as hard of numbers as the ones above. But they say that the average multiple before was 6, now it's 5, and that they're now seeing serious seller paper of 1.3 turns of EBITDA and frequently an earnout of 1 times EBITDA. So you've got a 1-point reduction in the price, and you've picked up 2.3 points of help from the seller, which is good because nobody is getting any senior debt. It's just not. I'm sure there's some senior debt out there, but none of my search fund entrepreneurs have been successful in attracting it. There's plenty of mezz debt out there.
So let me ask the other panelists. I mean, what this basically says is more calls for fewer deals, bigger deals that have more seller financing. Is that what you would have expected in the market? Is that consistent with your experience, or do you have outliers that you want to talk about, or is that what's your reaction?
I think the only part that surprises me is the bigger deals.
And I don't know how Jim would explain that, why the deal size went from $6.8 million to $13 million. But everything else seems to sort of fit for me.
Mm-hmm. Well, if you're thinking about doing a search fund, this data we just got it over the weekend, so it's really fresh. And I haven't been through it all, but it's pretty clear to me that 5 to 7 of the 18 funds are making 10 times as many calls a month as the median search fund in this universe. And there's an extremely positive correlation between the number of calls you make and the size of the deal that you uncover. It's just math. So I think that's the explanation, is that people that are really working the phones are just stumbling over bigger deals with more EBITDA.
And are they just cold call? I mean, is the way people go about this cold calling? I mean, you've already shot down my idea about going to private equity funds that want to unload deals. Are they just cold calling small businesses? Are they? I've been looking at other ways of doing business. Everybody says debt is the new equity, and so the way that you can buy interest in some companies is by going in and buying the debt. I mean, is there anybody that you know of out there buying the debt out of these companies? Or is that too much a big company thing?
I haven't seen it with search funds.
No,
I haven't seen it.
With private equity firms, I have seen where people will have relationships with private equity firms, and the private equity firms will throw them smaller deals that they would, that have some promise but don't fit their criteria.
Yeah.
But I haven't seen what you just said.
So how do you find?
No, we haven't seen it with search funds, but we have seen it with private equity firms. Yeah. But it's largely because a lender has a relationship with a private equity firm they think they can work well with, and the lender will say, can you help us with this company, either infuse equity or buy the debt. But I think that's much harder with search funds where there isn't that pre-existing relationship.
Now, do you all see search funders being kind of the farm team for private? I mean, they find deals that look private equity-like a lot of times. So in a way, they're going out there and doing the spade work. So is there any reason they shouldn't be looking at it just like a private equity firm would?
Inherently, no, but I think so much of it depends on the relationship. That private equity firms have probably a much better vantage point from which to work with the lenders, whereas the search fund has a much better, a more natural reason to be working directly with a seller. Mm-hmm. So I think there's a little bit of a structural difference, but in terms of just pure numbers, no.
So let's get you all to answer the question. How do you find, if people out here are thinking about doing a search, I mean, one of the things that you want to focus on is how do I find deals? How do I find attractive deals? My view of here I am becoming a panelist again, but I'll shut up after this one comment. My experience is that finding good deals is the key. After that, you can get financing. Mm-hmm. And it's hard, and you got to, You may have to get seller financing. You may have to get your mom or dad or cousins or your next door neighbor. Or you have to do something. But good deals get financing. So to me, the key issue is how do you find good deals? How do search funders find good? Have you seen any good deals lately? And how do they find them?
I'll take a shot at that. I see a variety of different things being tried by maybe the 3 or 4 things that get tried by everybody, and one person will do 100% of A, and another person will do 80% of B, and so different mixtures. But basically, you can be completely isolated and just dial the phone like crazy, get lists from people, and just call all day long and wrestle your way past the secretary, and eventually get through to maybe, I don't know, 1 in 200. But then eventually people look for ways to make that process a little smoother. They hire interns, and the interns do the initial calling. I think the interns have a much lower hit rate, but at least when they have a hit rate and you hand it to me, the searcher, I'm going to get right through to the guy or gal that wants to sell a business. Direct mail is surprisingly effective. Postal mail is surprisingly effective. The broker community these guys report that it's become slightly less helpful, not extremely less helpful. It's just they're seeing a reduced deal flow from brokers. But a broker brings you a deal, and you know the CEO is going to take your call when you call him. And then the old standby of finding a river guide within an industry that you're interested in, and having the river guide call the prospect and soften him up and say, you ought to take a call from Joel. He's a good guy. And those are really warm calls, and they result in very warm visits. So there are a variety of things you can do to make your life better than just dialing for dollars all day long for 24 months.
Tim, if you had a search funder, let's say you had 3 search funders come to call on you, and they were trying to raise a unit from you. One was had an industry focus and just said, I know everything about the security alarm business. Another one says, I am an opportunistic fiend. I am a relationship builder. People like me. I can make deals by going to conferences. And another one says, I am from a family that is in Chicago that's well known and has a lot of contact. Which one of those is most common? Those are kind of the 3 flavors you find: opportunism, geography, or industry. Which one of those appeals most to you, and why?
Ideally, I'd take them all and create a basket, because I think it takes multiple sourcing strategies to be successful. But if I had to pick, I would probably say in this market, the opportunistic person. I think the industry-focused searches, sometimes the well can run dry pretty quickly, either because of timing or industry dynamics, and the geographic constraint, depending on how close you draw that circle to your home base, can also just have natural limits to the number of companies in the target universe.
Is that a consensus among other investors?
We would be exactly the opposite. We would, I think we believe that there are an awful lot of private equity firms who are willing to operate in the same space that search funds are. They don't say they are. They don't say it in their brochures, but they're willing to buy companies with $2-3 million in cash flow. They have a big leg up with any intermediary. They're seen as more credible. They know where the debt is, particularly in a market like this, and they've got a track record of closing deals. So a broker will prefer to work with a private equity firm. In our minds, the opposite is true for a search fund. A search fund has a real advantage in relative terms against someone like Cambria. In terms of studying industries, getting in, it makes a world of sense. If they're going to live in the industry for the next 5 to 7 years, go learn about it, get to know everyone in the business, and then when you're evaluating a business, you're not trying to go through a fire drill of evaluating a business, but you're looking at that business against the metrics that you've seen from having looked at 20 or 30 businesses and having talked to 2 or 3 river guides about the industry. So the built-up knowledge in our minds for a proactive, an industry-oriented search fund is an enormous advantage, and we're much more keen on those. For that reason, we're much more keen on.
So that tells you that investors have different agendas, different flavors that they found successful. There's no right answer. You just have to keep searching for the investor that's buying what you're selling. Yeah,
Absolutely.
Which is not like any other, unlike any other business. What about the size of the deal? I mean, Jim's data shows that the size of the targets has grown. What size should searchers be looking at? I mean, what's too small and what's too big for this vehicle? Where do you start saying, I mean, $100 million in EBITDA is probably outside the range of, so clearly we know we're out there, and $1 is probably too small. So where in between would you say should be the sweet spot for folks like this who are thinking about going out and looking for companies?
Well, I sure feel like a $20 million company is easier to run than a $10 million company. And I feel like $10 million in revenue and $2 million of cash flow is the minimum viable size for a search funder to be looking at. Below that level, you're standing in front of a fire hose every day. You may even be signing payroll checks at the end of the week. You're certainly making collection calls, maybe driving out and picking up checks from customers. You're getting trucks rolling in the morning. It's just an unbelievably shallow management team that you've got beneath you in a company with less than $2 million of EBITDA. But as you get bigger, you've got enough money to afford a real controller, might even have a CPA designation. You can hire some kind of sales manager. You can have an operations person, and you can actually begin to engage in professional management. And in these smaller companies, you can't. I'm not too worried about the upper limits. I like you say, I don't know where my cutoff is. 100's definitely too big. 30's not. 40, maybe it's getting a little big.
So if you look at it, if you say $2 million in EBITDA, and if the average is 4 to 6 times, you got a $10 million acquisition. How many units do you want to have as a searcher? Some people have 8, some people have 15 or 20 units, some people have sort of institutional investors. In other words, how much dry powder should you have when you go out there to try to buy companies? Do you want to have 20 or 30 or 50 million available to do that, or are you willing to go out with 5 million available in your investor base? How does that range work out?
I think you'd probably want to have more than 10 because a unit that you've placed with an investor is basically a warm lead for when you have a deal that you're trying to raise money for, and you want as many of those warm leads as possible. So
10 investors or $10 million?
10 or 12 investors who can then produce. I mean, it seems to me that very few people get 100% participation from their search investors, so you're going to probably have to go outside of it. But you want as many search investors, 10 to 15, just to get as much of it there.
Okay, so that's probably the deal. Unless anybody has anything to add to how do you find deals, how are they priced, what's going on in the deal market. So let's turn to the capital market now. Is there any third-party debt available, and if so, how do you get it? How do you get it coming your way? What do you do?
I'm aware of 3 non-bank funds that do senior lending, and they seem to have a minimum requirement of $4 million of EBITDA.
They're doing cash flow lending or asset lending?
Cash flow.
You get their names.
I know the name of one. I'm aware of 2 others. Okay. So I'm trying to get them too. But they've never. I've sent them 3 deals that had more than $4 million of EBITDA, and they've found reasons not to like any of them.
So they're out there, but they're not closing any deals.
That's right.
Yeah. Well, the debt. I think. So what does that mean? Well, that means seller financing, doesn't it? Or all equity deals.
The other, but search funds have typically not wanted to do it, is to buy an asset-intensive business, a company with a lot of equipment, heavy on receivable. I mean, a distributor that has a lot of inventory or receivables, that can support senior debt. But for the companies that have been traditionally sought by search funders, which are simple, low asset intensity, you're not going to get senior debt today.
Yeah. Period. I mean, that's just...
Period.
Yeah.
But the seller notes that my group is seeing recently they are real notes. They're we used to see on a $2 million, well, let's say a $4 million EBITDA deal, a seller note for $3 or $4 million, but it amortized out over 3 years. That's not real acquisition financing. My favorite is an $8 million senior facility, 7-year term, 4-year interest PIK, 2-year, a 3-year interest PIK, 2-year interest only, and then 2 years of interest and principal amortization on a 10-year amortization schedule. So that's a real senior loan facility. And I've seen another one not quite that good, but kind of along the lines of 5 years and 7 or 8 year amortization schedule. So I think that and these deals are not. If a company is not experiencing a dislocation from the current environment, and there are some industries that are not, my most prolific searcher, he's had 8 companies under LOI, 2 are current and still working on them. He says, and he's operating in an industry that is largely unaffected by the current economic situation, and he says that he expects to see half a multiple of purchase price reduction and 1 full turn of seller debt and 1 full turn on an earnout. And, you're back to 50% equity days in a deal like that.
And actually, the deals that private equity guys have done that were 50% debt and 50% equity, they love those deals now because they're their survivors. Yeah. Where they got 7 or 8 times, those are the deals that they're having trouble with now, and so they're really relieved that they didn't over-lever.
I'm sorry.
Well, I was just saying I'm being a panelist again, but
my advice to someone that's thinking about doing a search fund would be not to worry about this, because it's kind of reverted back to the olden days of the way deals got done, and you're not going to buy a company from somebody that doesn't like you. Let's start with that. So you've got to establish a relationship and a friendship, a real friendship with that person during the process. And if it's a motivated seller, you can guide them to a structure that will contain the seller paper and the earnout you need to get your equity in at 50%. And you can blame it on your investors. You can point to this huge pile of cash you've got, but they've got strings, and my hands are tied here. And your job is just to make enough calls and present this package to enough people that one person says, yes, I'll take it.
Well, that's a nice lead into the third bucket, which is sort of the whole process of how do you go about, if you're a searcher, how do you go about it? So we've seen a little bit the number of calls you need to make. Views on doing it solo versus doing it in partnership. Any read on that particular issue? I know a lot of searchers struggle with that. Do they want to share the equity? Do they want to have somebody talk to you? Have you had a track record on one format working better than the other? Do you give preference to one over the other, or is it case by case?
I would say on balance, ultimately it has to do with the people. And one can succeed, 2 can succeed. On balance, I would say we probably had more success, or we lean toward 2-person search funds. It's got the disadvantage that it's a larger fund, and therefore there's more dilution. But I think one of the biggest vulnerabilities of search funds, and candidly, I think we think it's liable to come home to roost here over the next year, is that a lot of deals get done without particularly good due diligence being done. It's kind of a diligence light process. No one's putting in enough money that it really matters to them in terms of the investors. If you get 12 people each putting up $200,000 and it's not that material to them, then no one's really asking all the hard questions, and so sometimes they can get away with getting a deal done that doesn't have all the work that needs to be done. And we think that 2-person search funds are at least more willing. It's more likely that the diligence is going to get done. One of the big problems is that in our minds is that at the same time that as soon as you sign the LOI as a search funder, you're beginning to talk the deal up with your investors. You're talking to banks. You're selling immediately, and that's the time when you should be looking at the company, saying, "Do I really want to buy this company at the price I've negotiated and with the structure?" And it's hard. Just I mean, the dissonance of trying to be both a buyer and a seller at the same time is tough. So, two people is somewhat protection against that.
Would you rather do a deal, Lou, where you have one of the search fund investors is kind of a lead investor, may have several units, or may take the spillover and actually serves that role, or are you indifferent to?
We would much rather there be at least one lead investor, if not a couple, because and I think a number of search funders have preferred to run sort of a hub and spoke operation where there are lots of small investors. I actually think that's going to prove to be somewhat unfortunate for them, because when they get in trouble, everyone's got trouble in their portfolios, and where are they going to spend their time? They're going to spend their time where they've got $3 million committed, not where they've got $200,000 committed. And so they're going to people aren't, just as they didn't have to answer to people, now they're not going to be able to get as much attention as they might like.
Let me ask one last process question before opening it up to everybody here. And that really has to do, here are people who are approached all the time, who listen to pitches all the time. And you all, as searchers, are making pitches all the time. So what works with you and what doesn't? And I'll just start out by saying, if somebody walks in with a 28-slide PowerPoint deck, they starts out pushing them down my list. I don't like that, but that could be idiosyncratic to me. So you just talk about, what works when you meet somebody. What do you like and what do you not like when?
This is a still bewildering question to me to this day, and I had a conversation with Herb Grossbeck about this a month or two ago, and he feels like I do, and that is that after 45 minutes with someone, you really can't tell who's going to succeed and who's not. And if you kept track of those people over a 5-year period, kept track of the ones you turned down versus the ones you put money in, I bet you'd be astonished at the number of really good deals that you cut yourself out of. So it's tough, but I've seen 20. I've met or talked to on the phone with 20 to 25 forming search funds since November 1, and there's no way I'm going to do about 6 of them, and it's not a capital constraint; it's a quality constraint.
What's quality? I mean, you're making a judgment, Jim. What's it based on? Because these are the people who are trying to pass the test. Yeah. And what it takes to get through your screen.
Well, I know that I like to see someone who has burned the boats at the shore and can't go back to the homeland and is there to conquer some territory. And I don't like to see people who are choosing the search fund route as a default to a job because Wall Street isn't hiring or consulting isn't hiring this year. I think those are important ingredients. It's really hard to figure out what someone's motives are, but you can detect hunger in the interview, I think.
What else is important? What else do you look for?
Well, I'm in a lot of search funds where the entrepreneurs did not go to Harvard or Stanford, and by and large, I'm pretty pleased with the activity so far. And again, this current 18 is nobody's done a transaction yet, but I think if I don't know anything about the quality of the MBA program or the emphasis or the admissions requirements or something like that, that might give me some pause.
Mm-hmm. But the education has some impact. Anything else? Any of the rest of you look to?
I think beyond just the interview, I think what you said is exactly right about wanting people who are committed to the process. And I think you can look at their resume and see what experiences where they've had to make choices before. Have they gone to work for small companies or, just to show their sincerity to the process. And I think that's the thing in addition. So we look for people who've had, really compelling leadership experiences previously. Mm-hmm. And then I think also a huge part of success in being a CEO is being able to sell and market your business. And so, how persuasive are they? Could we see them selling us something? Because they basically are. So they're selling us a unit, and then I like to ask, would I want to work for this guy? Can I stand him? Because I think you want to have people that their team will respond to. So those are things we ask.
Yeah, I agree with all of that, and I would probably expand on the soft skills part a little bit. A lot of these businesses that are bought, are not white shoe law firm type environments where everybody comes out of an Ivy League school and has a fantastic pedigree. They're scrappy, they're down and dirty. Oftentimes, a fairly large component of blue collar workforce with older employees that have been there for maybe a decade or two. And I think there needs to be, a lot of maturity on the part of the buyer or the search funder in order to be able to walk in and step into that situation and have credibility and be able to pay attention to the finer nuances of the relationships that they have to build in a very short amount of time to keep those people on board, because that's part of the reason why you're buying the company is because the previous seller has done something right, and that includes the people they brought on. So you don't want to parachute in and then have all those other people dispersed because you rub them the wrong way and come in like a bull in a china shop. So I look for evidence of some sensitivity to be able to relate to a broad spectrum of people.
Anything you'd add?
Yeah, I would say that the key to us is that the person's eyes light up when they're talking about managing the business as opposed to doing the deal. Because we think the real value is created, and the much harder job is managing the business and creating value than it is getting a deal done. In the buyout business, it's not a good thing to say, but it's not that hard to get a deal done. It is really hard to create value once you've sort of wrestled it to the ground. And within that, the search funder is ultimately going to go be the CEO of the company. I think we look for people who are going to be CEOs less as generals and more as sort of sergeants, where they're going to have a mix of, sergeants have to lead, but they also they know how to get it done and roll up their sleeves and be a part of a team. And I think that is really important in these small businesses because you're not above the fray.
Yeah. So I'm going to turn into a panelist for 2 minutes here before we open it to questions and just give my answer to that question. I know some of you had me in class, but I really think that when you think about investors versus operators, I think of piles of marbles, and investors are brilliant at sorting the black marbles from the white marbles. They simplify it. They get all the black marbles on one side, all the white marbles on it, and they're able to judge it, make risk-reward decisions, and make investment judgments. Whereas operators are people who see 256 shades of gray. They really see the finesse, and it may be the soft skills, the people skills, whatever. And oftentimes, as a search firm, you have to be able to do both. You have to be able to make the deal, make the judgment, and then you have to have a different skill set that allows you to go in and operate. So on that side, I tend to look for people who have a track record of winning. I think people who've won tend to love to continue to win. There's just something about people who, whatever they've done, they've figured out how to win. They like to they don't like to fail. They kind of pay whatever price it takes. The second thing is that they're nice people. The guy that I used to work for when I first got out of business school was a guy who said, I want to hire somebody that I want to go have a beer with. Somebody I just really like. Likable people tend to do better. And then the other one goes back to your point that I look for as people who are good salespeople. I think in the end, Robert Louis Stevenson said, everybody lives by selling something. And I think in these small businesses, it's really your ability, whether you're getting a financing, you're selling. Whether you're hiring a new player on the team, you're selling. Whether you're getting a new product, you're selling. So I find people that are winners, sellers, and are nice people tend to be the ones that, and I realize that you don't need to come to Stanford Business School to think about those things, but I actually think those are probably the keys to the people that I want to back. Well, with that, let's open it up to questions, and you can range away from, where do you and how do you find deals, how do you finance them, and how do you run the process, to anything you want to do. Yeah.
Back on the deal side, in this environment, what industries or sectors of the economy are your searchers seeing the most activity?
Joel, can you repeat the question for the video?
Oh, okay.
We have to run around the microphone.
Sure. So the question is, in what sectors of the economy are searchers finding the most and maybe best deals? Where are you seeing the best activity? no activity out there.
Probably healthcare on balance, which is not.
There's a lot of healthcare activity, but healthcare is about 80 different industries, and they're not all alike, and they're not all good places to invest, but some are. Seeing some interest in software these days.
We call that the S word. But it actually can be a good business.
Business process outsourcing, a lot of outsourced back office processes, the PEOs and groups like that. There still seems to be a fair amount of interest in those kinds of companies. And energy, I'm starting to see more interest from the search funds I'm working with in energy services.
Yeah.
For Tim, you said you got a deal done. How sophisticated are the sellers? Do you go in and have to explain to them what EBITDA is? Do they have brokers? How sophisticated are they and ready for the process?
Okay, this is a question about the sophistication of sellers directed at Tim, because he did get a deal done.
Well, I didn't get the deal done, really. Somebody else, I just got to participate. But I think it runs the gamut. Some sellers are very sophisticated. Others, they operate just all up here in their head. And if you open up an Excel spreadsheet, they wouldn't be able to tell you where to look to find the numbers that you're asking about. But they sure know their business. And so most of them, I think, fall obviously somewhere in the middle. They know EBITDA. Some of them engage brokers. I think everybody starts out with a search fund hoping that they're going to find the mythical proprietary deal where there isn't a broker involved. But that also has pluses and minuses. These days, I don't know if it's changed at all. I'd be curious to hear if the other panelists are seeing any difference in the kind of sellers that are in the market today.
Well, I would say that maybe 10 or 15 years ago, the sellers couldn't spell EBITDA. And now they all know a friend that sold out for 7 times EBIT or something like that. They do not really think about the difference between EBITDA and EBIT. So you can always cast the purchase price as a multiple of EBIT, even though you're happy with the multiple as a multiple of EBITDA. And they can still tell their friends that they sold out for a big number.
Many of them probably don't also understand the difference between the two companies. That one may justify 7 times, and the other one's worth 2 times. I would say one of the things you don't. I came into this business out of the larger buyout business thinking it would be great because there were going to be unsophisticated sellers, and candidly, they can be your worst nightmare. You want someone who understands basic business principles, not how to run their business. They're all generally pretty good at that. But someone who, if there's a stumble on EBITDA, they're not going to be surprised that you want a price adjustment. If the working capital, they don't think they're going to be able to give you a business that has no inventory because they're going to get to keep that as well as sell you the business. So I think you're actually benefited if you have someone who's reasonably sophisticated, or at least not sort of just trying to there are a lot of shysters who may not be that sophisticated, and they're a problem.